welcome to the Dough Show, everybody. Happy Tuesday. Hope you're having a great day so far. This is the Dough Show, where we cover different topics that help you with your dough. We always like to joke around by saying you got to get your dough straight, whether it's your personal finances, your investments, your retirement investments, whatever it may be. We like to help you out with that. We're financial advisors with Jazz Wealth Managers. Hope you'll check us out. We manage long-term investment accounts, retirement accounts, and we manage our own portfolios, SEC registered fiduciaries. And so we're really excited about what we have there to offer you at Jazz Wealth if you're interested and maybe struggling with your retirement investments. Well, one of the things that we're doing this week is your retirement number, your retirement plan. We're going over it. Yesterday we talked about building your retirement plan and what that meant. You know, what should you have in there? What do you have to sit down and think about? What should you do with your spouse and think, you know, how much do we need and what are we going to do to get there? Just sort of a general overview. And today we are going to go through how much do you need to invest and where do you put it? So it's not a game show, by the way. We're just going over it. So we're going to use an example like I've done in previous videos, but I'm going to explain line by line what it is that you need to know about getting to that number and then sort of explain from there. Now, for all of our customers, we do it for you. We will help you come up with your number. We'll make sure you're on track, and then we'll tell you where to put it. We'll invest the portion here for you, and if it's better that you put money somewhere else, we'll guide you right to that as well. So, without further ado, let's get started here. So, what I want you to do, and we talked about this a little bit yesterday in our video, is your retirement number. Think in terms of salary, because you're really just going to quit working one day and you want the paycheck to keep coming in, right? Some maybe from Social Security, some from rental properties, royalties, businesses, retirement accounts. All of that's going to come into you to replace your income. So I always tell people, if you don't know how much in dollars you need for retirement, like is it $1 million, is it $5 million, $2 million, $1 million, what is it? If you don't know that answer, think in terms of salary. If you make $60,000 a year now and you more than comfortably support yourself, maybe you only need $50,000. Maybe you want to keep it at $60,000 and have a little extra fun money, because think, we might have our house paid off. We might be settled down somewhere. We won't need the flashy car anymore because we don't care, right? So little things will change along the way. You also should keep in mind healthcare costs will go up little by little. So you want to factor in that number. I always tell people, think in terms of salary. So the first thing is when you're looking at your retirement accounts here, how much, or your investments, how much have you saved already? Right? How much have you already put away? Is it zero? That's okay if the answer is zero. Because what we're going to do is we're going to work our way towards that number, you know? And so we need to have a starting point, and we go, well, you know, I've already put some money away. I have a 401k at work. I have an HSA, that counts as well. I have a Roth IRA somewhere. Doesn't, maybe you manage part of my Roth IRA, my taxable accounts, whatever it is. And so what I'm going to do is, as I go through this, I'm going to give an example, and I'm going to show you something really, really cool over here. We've never done it before, actually, so first time. Okay, so I'm going to ask our customers when they get started, how much have you already saved? If you're not one of our customers, no problem, not a sales pitch. Just write down on a piece of paper with your spouse, with you by yourself, if that's who it is, and write down how much you already have saved. I'm going to say that this person has $25,000 already saved. So as in our example, person comes to us and says, I'm doing whatever, and I have $25,000 already saved up. So that's the starting point. Got it? We're there? All right. Next thing. What's the number? What's the salary? Right? And so I'm going to say it like that. What's salary? What do you want? When you get to retirement and the paycheck shuts off, what's the amount that you like to have? And so in this case, I'm just, you know what? We should probably do a different color. Let's do it like this. So he's got $25,000 saved up, and in this example, I'm going to use $70,000 as the amount that they want. So maybe it's that the person makes more and they're willing to accept less in retirement. Maybe they make $70,000 now and they're like, I have no idea how much I need in retirement, so let's just go with my salary. Now, if you're one of our customers, you can put $70,000, $75,000, although it's a little different there. You could put, let's try for $100, let's try $50. Let me see a few different examples. Happy to do that for you, but you're gonna have a starting point. And so in our example today, we're going to say $70,000. Now, the next most obvious question is, hey, what age do you want to retire? What is it? Is it 63? Is it 60? Are you an early bird and you want to do 57? Are you thinking, man, I feel great. I'll just keep working until I'm 67. I love my job. I could see me, 67 years old, on whatever version of YouTube this is, and all grayed hair. Maybe I'll have some hair left, and still going. I love what I do. So I would be here every day until 67 or until my little body couldn't stand up anymore. So for me, it'd be a later retirement age. But what is your goal? Now, the most common response that I get is, Dustin, I don't know. How about 65? But I'd like to see 63 and 67. Can you do 3 of them? And so that's fine as well. By the way, if you're not a customer, please don't email me. I don't have a nice way to say that I don't have time to do all this for you. So, sorry. If you're one of our customers, of course, we work through it for you. Okay, in our example today, we're going to use 65. So to recap, he's got 25,000 saved for retirement, 70,000 is their goal, 65 is the year or the age they want to retire. So if you're keeping track, I'm giving you what you need to calculate this number. How much to save, what's the number you want, and when do you want to retire? Now, number 4, I know this obviously if you're working with us, but what's your current age? You got to know where you're at now, a starting point, right? You want to retire at 65, you're 30 now, maybe, I don't know how old you are, whoever's watching, but you go ahead and put your age down there as well. Now, number 5, we're going to do other income, right? And this one's tough because I was doing so well. I was writing and talking. This one's tough because some people, you might be 30 years old and you go, I'd like to own some real estate one day. I don't know if I'll get there, but I'd sure like to try for it. Well, I'm going to push you, okay? If you tell me, Dustin, this is where I'm at, and I plan on having a business, multi-level marketing business, I plan on having some sort of internet business, a YouTube channel, and you're more successful than I'll ever be, and you actually make money from doing this, then great. So you might have other incomes. My goal is to push you towards that while we're investing for you. I want the best for you, right? I want the best for everybody to get their dough straight. Your other views and things that you do in life, I don't really care. But as far as your dough goes, I want the best for you. So I will push you towards other income. Now, it could be you don't have anything else. You don't have any other skill or interests or anything. And maybe this is just going to be Social Security. Now, you have some choices. You can factor in a reduced amount. You can go check out what your projected Social Security benefits are if you like. You can estimate. You can have me estimate for you. And we can use some fraction of amount. Very, very few customers tell me, I want the full Social Security factored in at full retirement age, which is actually not 65, and I want to put that in there. Most people tell me, let's go a little light on that number. I just want to play it safe. Now, you could have rental property income, and in today's example, that's what I'm going to use. I'm going to say this person will have $2,000 a month in the future for rental property income. Now, they're only 30, so by the time they're 65, $2,000 a month in rental income is low. I'm assuming you guys can figure that out. So other income, $2,000 a month. Now, look, they want $70,000. We got 24 of it right here. So when you do this number, if you have, I don't know, some other form of income, this is where you're going to put it in there. You're going to say, well, I want 70. Look, I'm already taking care of 24 right here. Could I get that number higher? Is there anything I can do selling things on Etsy or whatever you do? Driving for Uber, something, could I get it a little higher? And if so, that makes your savings a little bit easier as far as your investing goes. Okay, now we want to know if that income is going to be taxable. All right? Not all other incomes are taxable, or maybe you're clever at how you get that income and you're able to defer taxes, or maybe it's post-tax money, who knows? But your other income, I just need to know, is it taxable? Is it Social Security? What are you thinking this is going to be? And so a lot of times, a lot of our customers are getting started in real estate, are a part of some real estate group, and so that's why I use it. It's pretty common right now. So $2,000 a month, and yes, that money is going to be taxable, the income portion. We're not talking about equity or appreciation or anything like that at the moment. We're talking about taxable. Now, the last question you're going to want to ask yourself is the rate of return. What do you expect the rate of return to be? We do this for all of our customers only because I know how I am about to invest for you. Again, if you have a lot of money saved, you've got a low number that you're shooting for, you have a long time until retirement, you have other income that's pretty sustainable, you may not need to invest aggressively. You see what the markets are doing lately, today, right? So you may not need to invest very aggressively, or you might go, Dustin, swing for the fences. I'm young, I got 35 years. Go ahead, invest as aggressively as possible. What's your rate of return? So you want to be very careful here. This is going to drive this whole equation, so I want you to really think hard about your rate of return. We're going to use the standard 7% today. Why? Because just like Dave Ramsey tells you to invest in those 4 mutual funds, that number will appease the biggest audience. So 7% tends to be a number that most people can agree upon, even though the real number to invest alongside the market is 9.8%. They use 7% because they back out inflation. If I can get geeky for a second, we are going to account for inflation as we go, not in this calculation as a whole. Big, big difference. Some people really bash me on those other videos, the $28 a week video and everything. Inflation is calculated as we go, therefore we don't have to guess. See, if you think, well, inflation is going to be, I don't know, 2-3% or whatever, and then you do your model on that and you're off by 1% for 35 years, you're going to be very disappointed. So rather than do that, I say let's go with 7% for this example, and then let's factor inflation at 3% for this year. It's high, I know. But then we can always, each year, if inflation comes in at 2.2, well then you're going to raise your amount by 2.2%. And so you can factor it as you go. That's the biggest thing that I think people make a mistake on there. But hey, you know, what am I going to do? Okay, so here's what we got. After we do all of this, you now know how to calculate your number. There is no excuse that you can't sit down and figure out what's best for you. How much you have saved, your salary, when you want to retire, a couple ages, your age now, that's obviously one age, other income, is it taxable, and what expected return do you have? This is a variable, this is a variable, this is a variable, and this one here is a variable as well. You could say other income is a variable, or the taxable thing. Otherwise, you can't change your age, you can't change how much you've already saved up for retirement, and so the rest of it's sort of fungible. You can play with whatever you want there. All right, so in this example, here's what we have here. I did the math just a minute ago. I hope I got it right. You have, this person needs to put $8,979 away in the first year to get to this goal. From there, they are going to raise that amount by whatever amount of inflation they expect or whatever happens each year. If inflation is 3% next year, you will raise that amount by 3%. If it's only 2% the year before, you will only raise that following amount by 2%. You see what we're doing there? I hope that drives home to some of you. That way we don't have to guess about inflation. Now, you go, holy cow, that seems like a lot of money just to get to this number. That's crazy. Watch what we do with this here. So this is the really, really important part here. 89.79 is what we have. What did we do yesterday? If you have a 401k with a match, you go up to the match. You contribute the amount that you have to up to the match. And in this example, I'm going to say that this 401k has a 3% match, which means that you are going to put in $2,100 into your 401k. That is mandatory. There is no way around that. The first step in this 89.79 is $2,100 into your 401k. Then the match, which is 3%, is going to be $2,100, right? So we've knocked out most of that right here, okay? Now people go, why wouldn't you just put the full amount? Why not just go 6%, wrap it up? Let's just go 89.79. Careful, right? So what you're going to do here, if you qualify, and I'm sure most of you do, you're going to go into your Roth and you're going to do the 47.79 into the Roth. And so in this example, the person that wants 70,000, I hope you can read all that gobbledygook. We're going to got 3% into their 401k. The company is going to give you $2,100 off of what your goal is. Now you see why it's so important that you get the match. If that match is 4%, you go higher. If it's 5%, you go to 5%. 6%, like the guy I talked to at Walmart yesterday, 6% at the Walmart 401k. I'm like, buddy, put the money in there. You don't need to talk to me. You need to put the money in your 401k. So that's your total. You got 2,100. You got 2,100. You got 4,779. Okay? And that's what you're going to do going forward. Okay? Now, why would you do that? Why would you do that there? So, yeah, actually, we'll just leave it there. Here's the thing. When you retire, you have really two buckets of money. You got this one here, and you got this Roth IRA down here. The match is sort of right there in the same chunk, right? I'm assuming this is a traditional 401k, by the way. So you've got this chunk of money and this chunk of money growing together. They're about the same amount, right? Give or take some dollars, they're basically the same amount. So each year when you up your contribution by the rate of inflation, 2%, 3%, whatever it is, those accounts are growing together. But this is a taxable account. This is not a taxable account. You go, okay, well fine, I'll take some from the 401k, I'll take some from the Roth IRA when I retire. No, right? This is your opportunity when you retire. What is the, 77,400 or something is the married 12% tax bracket for 2018. We don't know what it's going to be in, 35 years from now or whatever. But here's what you do. You start by taking some of the money out of your Roth. Why? Because when you take the money out of your Roth, it doesn't change your taxable income. You could take $1,000 out of your Roth IRA and your taxable income would be zero if that's all you had when you retired. If you take out, $30,000 out of your Roth IRA, when you retire, you have another $40,000 left to take out. If you took the $40,000 out of here, you'd pay 12%, right? And so if you start thinking, well, I'm going to take a little here and a little bit here, no, there's a great tax game to be played there, right? It could even be that in the earlier stages of your retirement, you're focused here and you're converting this here at a 0% tax rate. People that are retired right now really have it made because we have the potential to get income here and convert this for zero taxes, right? Not a lot. Right? But it's worth it. Every dollar counts. And so by you having these two accounts, you think, oh crap, all these years I've been investing and a third of it is taxes. No, that's what the general population tells you. People that geek out on this stuff and do this for our customers, this is where we go, wait a minute, whoa, wait a minute. I see you're retired now. Let's take 5 minutes and look through this and go, this is what I want you to do. We have a phone conversation. I want you to take X number of dollars from this. I want you to take X number of dollars from this and convert it to this so that you pay no taxes, okay? That's our game plan. Report back to me when you have the forms filled out or you've done what you need to do. Customer calls back. I've reported back. This is what I've done. I have this much scheduled to be taken out. I have this much scheduled to be taken out and converted to the Roth if it makes sense for you. And we go, great. Are there any dollars left? Have we pushed you to the top of that 0% tax bracket? Or maybe in the future it's 12 or whatever it is. If it makes more sense there than to bump yourself up into whatever the future tax bracket is, buddy, come on now. That's getting your dough straight, right? And so it's a general example. I get it. We can only go with what we know now. But those are the little things. So when people say, I don't need an advisor, I'm just going to buy something and buy an index fund and go for the ride. Okay, great. I have no problem with that. Do you know your number? If you know your number, you are already 1,000% ahead of every other person that simply read a book and said, I'm going to buy an index fund. So great. If you know your number, that's perfect. When you get to this point, let me help you get your dough straight. Let me make sure you pay less taxes. Yes, I'm going to charge you. Of course, we're here as a business. But this could mean so much to you. So if you don't need the help, I hope you understand it. Take some time, geek out on it, right? Read some more information on tax codes, get with your accountant, things like that. It's going to be helpful, right? And some of you that are 30, you go, I got forever to go. No, you don't, because this growing at the same pace or something similar to this is so important. If you go with the 401k your whole life and you just keep putting money in there, assuming you know your number, then when you get to retirement, I go, what am I supposed to do for you? I can't do anything with this because you don't have anything else to draw from. There's just no other game we can play. And so anytime someone calls and tells me, you got a 401k, I'm putting it up to the match, I don't feel like I'm doing enough, I go, great, here we go. If you're just getting started here, I get fired up. I have a feeling some people don't join us because I probably scare them. That's all right, you know? It happens. Anyways, cool. Yes, your number will change over time based on your life. Things will go wrong. Like I said, we have thankfully, we have the ability to work with lots of different customers. I'm obviously grateful. We do everything we can for you guys, but I get to hear some sad stories, you know, and that's the part that no test, no advisor license, no class, no online tutorial is going to teach you how to deal with people when they have, you know, sad stories. Things will happen in your life. Your job is to be emotional about whatever happens to you, family members passing, you know, divorces, whatever it is. I'll let you be emotional about that. My job is to hear you, let you vent, let you tell me the problems, and all the while I'm thinking about your money. All I care about is that you're on track or you have liquidity to get some of the money if you need to. Does this change your plan? What good news can I give you? Like I said, we're essentially heartless here when it comes to your money. We obviously don't want anything bad to happen to you, but yeah, ML, your life will have its ups and downs, and of course, you know, you hopefully have somebody that's not emotional about it to help you with it. Do you recommend a taxable account for someone who wants to be prepared for someone that wants to retire around 45? 45? Good Lord, what are you going to do at 45? Why do you want to retire at 45? What do you live in Florida? You're going to like sit around and play golf all day? A taxable account is an idea. Believe it or not, a SEP IRA, there's some very, very unique little things there if you happen to be self-employed or whatever. And then, of course, a Roth, you know, you fill that up as much as you can. You don't do anything taxable until that Roth is filled up, for sure. When you say how much you have saved in an emergency fund, is that included or just investments? Emergency funds are separate, ML. So emergency fund is for an emergency, right? Just liquid cash in a savings account, hopefully a high interest savings account. But those are not, usually people don't invest that unless their emergency fund is spilling over. And I'm confident that they have enough in their emergency fund. I won't let somebody say, I'd like to invest my emergency fund. That's not right. You know, if you said I have so much in a savings account and I just feel like I have too much in emergency funds, I'd work with you and say, let's just see, answer some questions, and if you really do have too much over there, okay, maybe you can invest it, but you should keep that aside. 30,000 subscribers, awesome. I'm going to ask every day. I really, really want to get in front of the industry, the people that have these conferences. There's so many cool conferences all over the United States. I want to go to all of them next year and I want to speak. Unfortunately, they don't take you very seriously when you're just some guy on YouTube. So I really, really am going to keep asking for people to subscribe. It's worked. I've noticed, by the way, a lot of you have done that. I am so thankful for that because I don't have any other ulterior motive, by the way. I want to get in front of these people. I want to talk to them. You know why? Because some of them are going to want to partner with us and we're going to be able to offer more to our customers. So that's sort of the underlying motive is I want access to more things for our customers so that they can just have more and more. So if I have to go talk in front of a bunch of people, which you know is tough because I'm used to talking to a lens that doesn't talk back, then I'm going to do it. We'll see what happens. If you organize your own portfolio of stocks, how many stocks are enough to call it diversified? Well, you brick station, so there's limitations there, right? So obviously cash is going to be a limitation. Whether you have enough to buy 50 different stocks are getting cheaper, but they are historically expensive. Also commissions, if you're paying per trade, then that's going to be a limitation as well. So diversified for me, assuming you can just buy as many stocks as you want or ETFs or whatever, diversified to me doesn't mean quantity, it means location. So if you really want to be diversified, first of all, ask yourself what type of return you can expect from that. If you're diversified, but you're only getting a 3% return, you know, what's the point? You know, you want to be diversified in a way that gets you to that goal. So to me, diversification means location, right? You have some large cap, maybe you have some small cap, you have some tech stocks that are independent of all of that. Maybe you have some retail that's in there. Maybe you have some Chinese tech stocks, for lack of a better thought at the moment. And so those are different locations, right? Gold is a different location, oil stocks. So you're sort of spread out by location. Whether you have 500 of those all over the place, 100 or 10, you're still technically diversified. But start with the limitations that you might have to begin with, commissions and cash, etc. Recommended value 401k to lower your tax bracket. A lot of people do that. Yep. So once you get up to the match, you fill up your Roth IRA. A lot of people will go back and say, look, if I just put in $1,000 in my 401k, I'm now going to be went from the 22% tax bracket to the 12% tax bracket. That's worth it for the $1,000. So I would say at least look into it. A pension could be included as other income. A lot of people have pensions where they're saying things aren't as bad as the media makes it out to seem. And so that pension, if you feel confident that that's going to be there for you in some capacity, that counts as other income for sure. Yep. Mario, I can't recommend individual stocks for retirement. I can point out we are going to talk about all three of those stocks. Well, not Coke, but we are going to talk about those other two stocks today on the closing beat for sure, because they are definitely moving today. Otherwise, I would say you sound like a Dow investor. You might just look at buying the Dow. It's going to be only 27 more stocks to buy, so you might like that. If your company offers both a traditional 401k and a Roth 401k, do you recommend one over the other? Ooh, that's a tough one for me to answer for you. I lean Roth. I say forget it now. All the taxes, knock them out, get them out of the way. I'll lean towards the Roth IRA. However, I can't tell you specifically what to do there, Olivia. You have to really look at what's best for your taxable situation now. If you make a boatload of money right now, it may be best to reduce your taxes now. If you think you're going to make more in retirement, that's the general answer without getting in trouble. Templeton Tech Stock Fund. Ooh, I don't know that one. I don't follow that one actually. I have an opinion, Cato, on the markets, and turns out I'm allowed to share my opinion. So on the closing beat today, I want to kind of outline some of those things for sure, where the stock market's at and what I think is going to happen going into the end of the year. I could be wrong, but I just thought I'd have fun with it. All right. Does a dividend can be other income? Yeah, you might get to retirement and decide to take the dividends in the form of cash rather than reinvest them. If you currently are not in retirement, your dividends should be reinvested automatically. You should definitely do that. So when you get to retirement, you could count it as other income, sure, if you have it set up that way. Some people say, nope, just keep reinvesting it. But hey, that's all I got for you today. We'll be back at 5 o'clock for the closing beat. Active day in the stock market. I got a lot to say about that. Thank you so much for watching, and thank you for hitting the subscribe button. Really, we have noticed. Thank you. I really appreciate it. So keep that up and tell your friends, and we'll be back at 5 o'clock. See you then.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.
Hey, wait! Before you go watch one of our other great videos, have you had a chance to see our new Fin Tips videos? They focus on one topic at a time, covering investing, personal finance, and anything that can quickly help you with your dough. Best of all, we'll keep it real short, because we know time is money.